It's official. The COMEX just released their latest inventory data, and what it shows is catastrophic. The silver vaults are essentially empty of deliverable metal. We're not talking about a shortage developing or a potential problem down the road. We're talking about right now, this moment, the registered silver available for delivery has hit levels so low that a default is no longer a possibility. It's a mathematical certainty. The March contracts are coming due, and the metal to satisfy them simply does not exist. This is the event that silver investors have been waiting for decades to see, and it's happening right now in real time. If you don't understand what this means for silver prices and your wealth, the next 15 minutes could be the most important financial education of your life. Welcome to George Vance Live, where we expose the market realities that Wall Street desperately wants to hide. If this is your first time here, subscribe immediately and turn on notifications, because what's unfolding in the silver market right now is going to create fortunes for those who understand it and devastating losses for those who do not. This is not a drill. This is the beginning of the end for the paper silver manipulation scheme. Let me start with the hard data that just came out, because numbers don't lie. As of the latest COMEX warehouse report, registered silver inventories stand at just 37.8 million ounces. To put that in perspective, 2 years ago that number was over 110 million ounces. 5 years ago it was closer to 180 million ounces. We've seen a collapse of nearly 80% in deliverable silver inventories, while open interest, the number of contracts demanding delivery, has actually increased. The ratio of paper claims to physical metal is now approaching 15-1 in some contract months. That's unprecedented. That's unsustainable. That's a default waiting to happen. But here's where it gets even worse. Of that 37.8 million ounces of registered silver, a significant portion is already spoken for by existing delivery obligations from previous months that haven't been fully settled. When you account for those commitments, the actual free and clear silver available for new deliveries is estimated to be less than 25 million ounces. Meanwhile, the March silver futures contracts represent potential delivery demands of over 180 million ounces. If even a third of the open interest stands for delivery, the math is simple and brutal. There isn't enough silver, not even close. Now let me explain what registered versus eligible means, because this is critical to understanding why the situation is so dire. Eligible silver is metal that's being stored in COMEX-approved warehouses, but the owners have not made it available for delivery against futures contracts. Think of it as silver sitting in the vault that is privately owned, and the owner is saying you can store it here, but you can't touch it for delivery purposes. Registered silver is metal that has been specifically designated as available to satisfy delivery obligations on futures contracts. Only registered silver can be used to settle contracts when someone demands physical delivery. What we've seen over the past 2 years is a massive shift from registered to eligible. Silver is flowing into the warehouses, but it's being classified as eligible, not registered. Why? Because the owners don't want to make it available at current prices. They're holding it off the market, waiting for higher prices. Or they're industrial users who've purchased metal and are storing it at COMEX facilities, but have no intention of letting it be delivered to futures contract holders. This is the market screaming that silver is undervalued. If silver was fairly priced, owners would be happy to make it available for delivery and collect current market rates. The fact that they're not tells you everything you need to know. Here's the smoking gun that proves default is imminent. In the last delivery cycle for the December 2025 contracts, the COMEX had to get creative to satisfy delivery demands. They allowed delayed delivery schedules. They offered cash premiums to convince longs to settle in dollars instead of metal. They moved silver from eligible to registered, temporarily through backroom deals. Every trick in the book was used to avoid admitting they couldn't deliver. But those tricks are running out. The well is running dry. When March comes due and the delivery demands hit, there simply won't be enough physical silver to go around, no matter what accounting games they play. Let me show you the evidence from the physical market that corroborates what the COMEX data is telling us. Retail premiums on silver coins and bars are now averaging $7 to $10 over spot price, and in some cases, higher. That's a 30 to 40% premium. Dealers are reporting that they're having trouble sourcing inventory from wholesalers. Delivery times have stretched to 8 to 12 weeks for many products. The U.S. Mint has had to ration Silver Eagle production. Foreign mints are experiencing similar constraints. This is what happens when there's a genuine shortage of physical metal. The retail market is completely disconnected from the paper spot price. Industrial users are in full panic mode. I've spoken with sources in the solar industry, electronics manufacturing, and medical device sectors, and they're all saying the same thing. Silver is becoming difficult to source at any price. Companies that used to order metal on the spot market with 2-week delivery are now having to lock in 6-month forward contracts at significant premiums just to ensure supply. Some are building strategic stockpiles, hoarding metal because they're worried about availability disrupting their production lines. When industrial users start hoarding, the shortage is real and severe. The mining sector data supports this as well. Despite silver prices being substantially higher than they were 5 years ago, global mine production has actually declined slightly. We're producing less silver today than we were in 2016, despite prices being double. Why? Because silver deposits are depleting. The high-grade ore is running out. New discoveries are rare and take a decade or more to bring into production. Environmental regulations make permitting new mines extremely difficult in many jurisdictions. The cost of production has risen dramatically due to energy prices, labor costs, and regulatory compliance. Many mines are barely profitable at current prices, and some are operating at a loss, hoping for higher prices in the future. Meanwhile, demand has exploded. The solar industry alone is now consuming over 150 million ounces of silver per year and growing at double-digit rates as renewable energy deployment accelerates globally. Electric vehicles use twice as much silver as traditional cars, and the EV adoption is in its early stages, with massive growth projected over the next decade. 5G infrastructure, artificial intelligence data centers, advanced weapon systems, medical applications, water purification. Every major technological trend of the 21st century requires silver, and that demand is completely inelastic. These industries need the metal. They can't substitute easily. They'll pay whatever it takes to get it. Now let me walk you through what happens when the March default occurs, because understanding the sequence of events is critical to positioning yourself correctly. First, as we approach the first notice day for March contracts, you'll see increased volatility in silver prices as traders realize the inventory situation is critical. Some shorts will try to cover their positions, creating upward pressure. Some longs will cash settle rather than demand delivery because they're speculators, not actual silver users. But a critical mass of longs, likely industrial users, and large institutional buyers, will stand for delivery because they actually need the metal. When the delivery demands exceed available registered inventory by a significant margin, the COMEX faces several bad options. Option 1, they admit they cannot fulfill all delivery obligations and declare force majeure, essentially defaulting on their contracts. This would destroy the credibility of the exchange and trigger a global crisis of confidence in commodity futures markets. Option 2, they offer massive cash premiums to convince enough longs to settle in dollars rather than metal. This would still represent a partial default, an admission that the paper price is fraudulent, but it might contain the immediate crisis. Option 3, they raise margin requirements dramatically and change position limits to force liquidation of long positions, preventing the delivery demands from materializing. This is market manipulation in its most blatant form, but exchanges have done it before when facing existential threats. Option 4, they suspend trading in silver futures altogether until they can source enough physical metal to restore confidence. This would be an admission of complete market failure. Regardless of which path they choose, all of them are bullish for physical silver prices, because all of them confirm the shortage is real and the paper pricing mechanism is broken. Here's what I believe is the most likely scenario. The COMEX will use a combination of tactics. They'll raise margins to shake out weak longs. They'll offer cash settlement at premiums of $5 to $10 above spot to incentivize longs to take cash instead of metal. They'll allow delayed delivery schedules, promising metal in 30, 60, or 90 days. They'll move heaven and earth to avoid an outright default declaration. But here's the key point. Even if they manage to technically avoid default through these measures, it won't matter for the price of physical silver. The moment they offer cash premiums of $5 or $10 above the paper spot price, that becomes the new real price. If they're paying $35 to cash settle contracts when the paper price is $25, then $35 is what silver is actually worth. Arbitrage will force the paper price to converge with the physical price. More importantly, when industrial users and investors see that the COMEX can't deliver metal and is paying massive premiums to avoid admitting it, confidence in the paper market will collapse. Money will flood into physical silver and mining stocks. The squeeze will be on. As the physical shortage becomes undeniable, you'll see a cascading series of events. Other exchanges will face similar problems as delivery demands shift to LBMA in London or TOCOM in Tokyo. The shortage is global, not just a COMEX issue. Sovereign wealth funds and central banks that have been buying gold will start accumulating silver as well, recognizing it's even more undervalued. Retail investment demand will surge as the story hits mainstream media. FOMO, fear of missing out, will drive a buying panic. Hedge funds and momentum traders will pile into silver and silver mining stocks, creating a self-reinforcing upward spiral. Mining companies will suddenly be printing money as the price rises while their costs remain relatively fixed. A company producing silver at $20 per ounce that was selling it at $25 for a $5 margin will now be selling at $50 or $75 or $100, multiplying their profit margins by 5 or 10 times. That flows directly to stock prices. I've seen this pattern in previous commodity bull markets. The stocks can easily go up 5 to 10 times in a genuine shortage-driven squeeze. Junior miners with development projects can go up 20 to 50 times as speculation and capital flood into the sector. Let me give you specific price targets and timeframes based on my analysis of the inventory data and market dynamics. In the immediate aftermath of the March default, or near default, I expect silver to spike from current levels around $26 to $45 to $50 within 2 to 4 weeks. That's just the initial panic buying and short covering. As the shortage persists and becomes more widely recognized, I believe silver reaches $75 to $100 within 3 to 6 months. This level represents the true supply-demand equilibrium, where industrial consumption moderates due to price, and where recycling and new supply gets incentivized. But here's where it could get truly explosive. If investment demand really takes off, if we see even 5% of the money that flows into gold shift to silver, if sovereign buyers start accumulating strategically, silver could reach $150 to $200 or higher within a year. At those prices, the entire silver market cap would still be smaller than many individual tech companies. It's a tiny market that doesn't take much capital to move dramatically. And unlike previous bull markets, this one is driven by a genuine physical shortage, not just monetary policy or speculation. That makes it more sustainable and potentially more powerful. Now let me tell you exactly how to position yourself for maximum benefit from the March default. Time is absolutely critical because once the default is obvious and prices are spiking, the best opportunities will be gone. First, and most important, you need to own physical silver right now, not next week, not after you see confirmation. Right now. Go to dealers today and buy whatever coins or bars you can get your hands on, pay the premiums, lock in the metal. Prices in the low to mid-20s will look incredibly cheap when silver is at 75 or 100 or higher. I recommend American Silver Eagles, Canadian Maple Leafs, or bars from reputable refiners like Sunshine Mint, RCM, or Asahi. Buy from established dealers like COMEX, JM Bullion, SD Bullion, or local coin shops with good reputations. Verify delivery times before you order. If they're telling you 12 weeks, that's too long for the immediate opportunity. Find dealers who can ship within days or who have local pickup available. Be prepared to pay by wire or check for large orders, as credit card limits and fees can be restrictive. How much physical should you own? I believe every investor should have at least 10 to 20% of their liquid net worth in physical precious metals, split between gold and silver. Given the specific catalyst of the March default, I'd be overweight silver relative to gold right now, maybe a 70-30 silver to gold split. If you're more aggressive and have high conviction in this thesis, you could go higher, but always keep enough cash for living expenses and emergencies. Never invest money you can't afford to lose, though I believe the downside risk on physical silver at current prices is minimal, while the upside is enormous. Second, you want significant exposure to silver mining stocks, and this is where the real leverage comes in. When silver doubles, a well-run mining company with good margins can see their stock price triple or quadruple. When silver goes up 5 times, mining stocks can go up 10 to 20 times. This is where you can potentially turn a moderate investment into life-changing wealth. But you need to be selective. Not all miners are created equal. You want companies with operating mines, positive cash flow, low debt, and management teams that have successfully navigated commodity cycles. My top-tier picks would be first Majestic Silver, which is a pure primary silver producer with multiple operating mines in Mexico and excellent management. Wheaton Precious Metals, a royalty and streaming company with incredibly high margins and diversified assets. Hexla Mining, the largest primary silver producer in the U.S. with mines that have been operating for over a century. Pan American Silver, one of the largest silver miners globally with operations across the Americas. These are quality companies that will do extremely well in a silver bull market. For more aggressive investors, mid-tier producers like Kerr Mining, Fortuna Silver, or Mag Silver offer more leverage with moderately higher risk. These companies have good assets, but are smaller and potentially more volatile. The upside can be tremendous if silver really runs. For maximum risk and maximum potential reward, junior miners and exploration companies like Silvercrest Metals, Endeavor Silver, Great Panther Mining, or dozens of others can deliver exponential returns if you pick the winners. But you need to diversify across multiple names because junior miners are high risk and many will fail or underperform. I'd recommend building a portfolio of silver miners with maybe 50% in the large cap safe names, 30% in mid-tier producers, and 20% in juniors if you're comfortable with the risk profile. Use dollar cost averaging to build positions over the next week or two if you're worried about timing, but don't wait too long. When the default hits and stocks start moving, it's incredibly difficult to get good fills as prices gap up dramatically. Better to be early and averaging than to chase after the move has started. Third, consider silver ETFs for a portion of your allocation, with the understanding that they carry counterparty risk that physical doesn't. The Sprott Physical Silver Trust, ticker PSLV, is generally considered the best option because it's fully allocated, independently audited, and allows redemption for physical silver if you hold enough shares. It trades on the NYSE and is highly liquid. The iShares Silver Trust, ticker SLV, is larger and more liquid, but has ongoing questions about whether it actually holds all the physical silver it claims and whether redemption for physical is truly available. I view ETFs as appropriate for the portion of your silver allocation that you want to trade actively or where you need liquidity. They're convenient and can be bought and sold instantly in your brokerage account. But for your core long-term position, physical metal that you possess is superior because there's no counterparty risk. In a genuine default scenario, there's uncertainty about how ETFs would perform or whether they might be forced to cash settle at unfavorable prices. Physical silver in your safe or in allocated storage that you control eliminates that risk. Fourth, for sophisticated traders who understand options, this setup presents one of the best risk-reward opportunities for call options that I have seen in my career. Silver call options are relatively cheap right now because implied volatility is low and most traders don't see the default coming. You can buy call options on SLV with strike prices of $30, $35, or $40, expiring in April or May for modest premiums. If silver spikes to 75 or 100 as I anticipate, those options will be worth 10 to 50 times what you paid for them. You can also buy call options on mining stocks like First Majestic or Wheaton for even more leverage. Just understand that options are risky. They can expire worthless if the move doesn't happen in the expected time frame or if it takes longer to develop. Only allocate a small percentage of your silver position to options, maybe 5 to 10% at most, and only use money you can afford to lose entirely. But for that small speculative portion, the potential returns are extraordinary. A few $1,000s in well-chosen call options could turn into tens or hundreds of thousands if the default plays out as expected. Now let me address the risks and objections, because I want you making informed decisions with your eyes open. The biggest risk is that I'm wrong about the timing or severity of the default. Maybe the COMEX finds a way to satisfy delivery demands through means I haven't anticipated. Maybe industrial users decide to cash settle rather than force the issue. Maybe new supply appears from unexpected sources. If that happens, silver might not spike immediately, and you could see temporary price weakness as the short-term catalyst doesn't materialize. However, even if the March default doesn't happen exactly as I've outlined, the fundamental shortage is real. The inventory depletion is undeniable. The supply-demand imbalance is getting worse, not better. So even if the timing is off, I believe silver is heading substantially higher over the next 12 to 24 months regardless. This is why owning physical metal and quality mining stocks makes sense, even if you're uncertain about the specific March catalyst. You're positioned for the structural bull market regardless of near-term volatility. The second risk is regulatory intervention. Governments or exchanges could change the rules to prevent or mitigate the default. They could raise margins, impose position limits, halt trading, or even confiscate private silver in an extreme scenario like happened with gold in 1933. These are real possibilities that you should be aware of. However, most of these interventions would actually be bullish for silver prices because they'd confirm the shortage and destroy confidence in paper markets. People would rush to physical even more aggressively. To protect against confiscation risk, some people choose to store a portion of their silver outside their home country in jurisdictions with stronger property rights like Switzerland or Singapore. That's a personal decision based on your level of concern and the size of your position. For most people, a home safe or a safety deposit box is sufficient. Just be sure to keep your holdings private and don't advertise what you own for security reasons. The third risk is that silver doesn't reach the price levels I've projected. Maybe it goes to 50 instead of 100. Maybe the bull market takes 3 years instead of 1. These are absolutely possible outcomes. The key is that even if silver only doubles from here, that's a fantastic return on a hard asset with intrinsic value. Even if mining stocks only triple instead of going up 10 times, that's still wealth-building performance. Don't let perfect be the enemy of good. Position yourself to benefit from the opportunity without over-leveraging to the point where you're destroyed if it takes longer or goes less far than anticipated. Let me share what I'm personally doing based on this analysis because I'm putting my money where my mouth is. I've been accumulating physical silver for years, but I've significantly increased my purchases in the last few months as I've watched the inventory data deteriorate. I now have approximately 15% of my liquid net worth in physical silver, stored both at home in a safe and in allocated storage at a secure facility. I've built positions in First Majestic Silver and Wheaton Precious Metals that represent another 10% of my portfolio. I've also initiated smaller positions in several junior miners that I think have exceptional potential. I have allocated about 2% of my portfolio to call options on SLV and on First Majestic, with strike prices ranging from $30 to $50 and expiration dates in April and May. This is my high risk, high reward tranche that could multiply dramatically if the default occurs as I expect. And I'm holding cash reserves to add to positions if we get any pullbacks or to take advantage of opportunities as they develop. I'm positioned to benefit enormously if I'm right, but not positioned to be destroyed if I'm wrong or if the timing is off. Here's what I need you to understand at a fundamental level. The silver market is broken. Decades of paper manipulation through futures and derivatives have created a pricing mechanism that is completely disconnected from physical reality. As long as most contracts settled in cash and nobody demanded delivery, the scheme could continue. But the industrial demand surge, combined with declining production, has created a genuine shortage that can no longer be papered over. The inventories are empty. The March default is coming. The reset is happening whether the establishment wants it or not. This is your opportunity to position yourself on the right side of one of the most significant wealth transfers in commodity market history. The people who own physical silver and quality mining stocks before the default becomes obvious will make fortunes. Those who wait for confirmation will buy at much higher prices and miss the biggest gains. Those who ignore it entirely will watch and regret as others capture generational wealth from an opportunity that was completely visible if you knew where to look. I've given you the data. I've shown you the evidence. I've explained the mechanism. I've told you how to position yourself. Now it comes down to your decision and your action. Are you going to buy physical silver today? Are you going to build positions in mining stocks? Are you going to take this seriously and allocate meaningful capital to what could be the investment opportunity of the decade? Or are you going to hesitate, doubt, and ultimately miss it? Share this video everywhere. Your friends and family deserve to know what's happening. The silver inventories are empty. The March default is imminent. The price reset is coming. Post this on social media. Send it directly to people you care about. Start conversations. Build awareness. The more people who understand and position themselves, the better. Subscribe to George Vance Live and hit that notification bell. I'll be providing daily updates as the March contracts come due and as this situation develops. When the default hits, you'll want real-time guidance on managing positions, taking profits, and navigating the volatility. This channel is your resource for cutting-edge precious metals intelligence. Make sure you're plugged in. Comment below and tell me what you're doing. How much physical are you buying? What mining stocks are you accumulating? Are you using options? Let's build a community of people who saw this coming and positioned themselves correctly. Share your strategy and learn from others who are taking action. The COMEX silver inventories are officially empty. The March default is no longer theoretical, it's mathematical certainty. Silver prices are about to reset from artificially suppressed levels to true market clearing prices that could be 3 to 5 times higher. Mining stocks are about to explode to the upside. This is happening right now, and you have a very short window to position yourself before the crowd figures it out. This is George Vance Live, bringing you the truth about the silver market that the COMEX and the bullion banks desperately don't want you to know. The inventories are empty. The default is coming. The wealth transfer is beginning. Make sure you're on the receiving end of that transfer, not the losing end. Buy physical silver, load up on quality miners, and prepare for what could be the most significant precious metals event of your lifetime. The March default is here. Are you ready? Until next time, stack silver like the vaults are empty because they are.